Hi friends, today I'm going to review the book Selling Your Business, The Transition from Entrepreneur to Investor by Louis P. Crosier. Preparing for your sale. Begin planning the sale of your company and choosing an advisory team long before you decide to sell. Ideally, start planning when your company has a low value. Decisions you make on such basic factors as the firm's initial structure can have an enormous impact on your exit strategy later. The 5 most important considerations in structuring your business are: limitation of personal liability. New ventures are risky. Protect yourself. Flexible tax planning. Can you put assets in or take them out without tax penalties? Control and management. In a general partnership, one partner's decision binds the other partners. A limited partnership provides some of the advantages of partnership while limiting some of the risks. Capital structure, think short, medium, and long term. Corporations have access to the equity markets, but equity financing can dilute control. Consider issuing founder stock, using shareholder agreements and other tactics. Exit strategy, make it flexible and as easy as possible. You don't know when you begin a business whether you will want to exit early or wait for an IPO. The obvious tasks are raising money and setting up a business, deciding on business structure and capitalization, choosing advisors, creating a board of directors, setting up employee benefit plans, and determining how, when, and with whom to share equity participation. Your professional advisory team should include 1. A certified public accountant. Your CPA not only handles financial reports, but also establishes financial systems and offers advice on business planning. 1. You may want an individual accountant to handle your personal financial planning. 2. An attorney. Your lawyer will establish the legal structure of the enterprise, handle all regulatory filings, and offer advice on such issues as liability limitation. 3. An insurance agent. You want advice about directors and officers' protection and risk, life insurance for key people, and employee benefits such as health insurance. 4. An investment banker. If you anticipate an IPO, you will want expert help. 5. An investment advisor. Have someone help you make choices about investments and asset allocation, and to advise you on employee programs such as 401k plans. As an entrepreneur, you most likely earned your wealth by being intensely focused on a single mission. Advisors come with histories, brands, and firm affiliations. It is easy for an entrepreneur to be overly impressed by a blue-chip firm's name and not pay enough attention to the individuals who will provide your service. So exercise due diligence on advisors. You'll be working with the people, not the name of the firm. Find out where they trained and what their experience has been. How much involvement have they had in your industry? How many deals have they done? Check references and remember that the best salespeople are often the worst advisors. Making your deal. Entrepreneurs often focus on getting things done, and sometimes their perspective becomes too narrow at the business sale stage. They are so eager to get the sale done that they accept deals that are far less advantageous than might otherwise be possible. Consider your options carefully, particularly in regard to 1. Earn-out and escrow arrangements. These are common when a company is purchased for cash. 2. However, they are not good for you as the seller because they make your payment conditional on factors that may be beyond your control. 3. Limit escrow arrangements to an auditor's finding that your firm's past performance was as you represented it. 4. Never agree to escrow against a guarantee of future performance because you will have little control after the sale. 5. Stock arrangements. When a buyer purchases your company for stock, insist on terms that let you sell the stock immediately. 5. Accept only registered stock. 6. Affiliate arrangements. Beware of any offers of executive status or board seats in the new company. 6. Such positions may make you an insider for SEC purposes and would complicate any decisions you make to buy or sell stock. Liquidating your company. If you sell your company for stock, you will end up with a large position in a single investment. That can be risky. Think like a trader. If you had received cash instead of stock for the sale, would you have used the cash to buy the stock you now own? In most cases, the answer will be no. By building a company and selling it, you have already made the greatest profit on the company that anyone is apt to make. You have already risked a great deal and won. Why continue to bet on the same company when one of the elements most responsible for its success, the founder, no longer controls it? Consider this decision tree. 1. Determine the minimum amount of money you would want for a guaranteed wealth cushion, money that you don't want to risk. 2. Assume that you can only earn a return of 1.5% a year on this wealth. 2. How much do you need to keep yourself in the style you want? 3. Sell enough stock to raise this amount, pay the taxes, and get on with your life. 4. Consider selling the rest of the stock over time so you can construct a diversified portfolio based on your future expectations, not your past experience. Choosing your reinvestments. The reinvestment decision should take time. Don't be hasty. If you have $100 million invested in stocks, your portfolio could easily fluctuate by $5 million in a month. As a newly rich prospect, you will get plenty of calls from investment advisors and scam artists eager to separate you from your money. That is one reason to select a good, reliable team long before you get really rich. People who worked with you honestly when you weren't rich will probably work with you honestly after you come into your windfall. If you put your cash in safe government securities such as T-bills or municipal bonds, you can contemplate a future investment plan at your leisure. Your cash will be safe, and time will be on your side. Following your money. When brokers, investment salespeople, and others approach you with new offers, follow the money. Find out how those people get paid. Dig deep into the details. You'll find that many get higher commissions for putting you in higher risk investments. That may be good for them, but bad for you. In general, actively managed funds are a mediocre to bad bet, yet commissions on sales of actively managed funds are higher than on some of the best index funds. An investment salesperson's first priority is his or her personal wealth, not yours. Also understand that wealth management and investment firms may have conflicts of interest. Some fund companies have paid kickbacks to some brokerage firms, and the brokerage firms in turn have hyped those companies' funds. These relationships are not always clearly disclosed. Be diligent and follow the money. Asset allocation. Investment research demonstrates that asset class is responsible for the lion's share of returns on any investment. Your decision to invest in stocks and bonds will make more difference in your returns than precisely which stocks or bonds you buy. As an entrepreneur, you had an extremely concentrated position in one company and one industry. You took an enormous risk. It worked out well, or you probably would not need this book. Now that you have sold your business, you are in a position to gain wealth by taking somewhat less risk. By owning a broadly diversified portfolio of stocks, bonds, real estate, and other assets, you will not earn windfall returns when any particular asset class does well, but you will earn respectable returns in any environment. A bear market in stocks will not devastate your portfolio if you have offsetting positions in bonds and real estate. Inflation, bad news for the bond market, will not decimate your wealth if you also hold inflation-proof gold and stocks. The definitive acquisition agreement is the legally binding agreement signed by the seller and the buyer, setting forth the rights and obligations of each of them in the purchase and sale of the business. Don't trust chance for your asset allocation, an area of much recent study. Indeed, economists who specialize in this issue have won Nobel Prizes. Engage an advisory firm with a good level of expertise at modeling risk and making asset allocation decisions. The investment policy statement. As a high net worth individual, you need an investment policy statement. Put your most important investment considerations in writing, notably 1. Objectives. Why are you investing and what do you expect to achieve? 2. Return. What do you want or need to earn? Keep this decision firmly in mind when other investors are making runaway profits in, for example, a stock market bubble. 3. Risk. What chances you are willing to take? Are you willing to use derivatives, for example, or to invest internationally? 4. Moral or ethical parameters. For example, will you invest in tobacco stocks, utility stocks, or bonds of countries that do not respect human rights? Know the risks. Risk is the most fundamental, ubiquitous factor in investing. There is no return without risk. The art and craft of successful investing is usually a matter of gaining as much return as possible for a given level of risk. Risk comes in many guises. Inflation risk can whittle away at the value of cash you stuff into a mattress. Equity market risk subjects your stock portfolio to wild swings. Interest rate risks can send your bond portfolio up and down. Every adult should have a will. The will is important in that it is where you appoint an executor of your estate and name guardians of minor children. Different people have different appetites and levels of tolerance for risk. The young can usually afford to take more risk because they have more time to recover. As an investor, you took enormous risk building a company. You reaped returns. Now take a cold, hard look at risk and decide how much you really need. Past performance and future performance when choosing an investment manager or a fund. Remember that past performance is no guide to future results. Studies show that a well-diversified index fund will usually outperform active stock pickers over the long term. Yet in any short period, 1 year, 5 years, 10 years, any given active money manager may look like a superstar. The law of averages usually asserts itself, and managers who perform outlandishly well in one period are apt to perform poorly in another. It balances out. Don't chase performance and don't pull your money away from an investment manager who has just turned in 1 or 2 bad quarters. If you have developed your investment policy statement and chosen your managers carefully, be prepared to ride out good times and bad. With the possible exception of volunteering, the direct gift is the simplest way to give. Remember the relationship between risk and return. Make due diligence and double-checking part of every decision. When you select a manager, do not judge on returns alone. Consider 1. The Sharpe ratio. This metric measures performance against risk. 1. Consider after-tax and after-fee performance when you apply the Sharpe test. 2. Metrics. What benchmark does the investment manager use and how did the manager's Sharpe ratio compare to the benchmark? 3. Experience. How long has the manager been in the game? Track records of less than 3 years are statistically insignificant. Emotional ramifications. You built a great company and sold it. Now you have a substantial fortune. Prepare yourself for an emotional crisis. Your money may change your relationship with friends, family members, and colleagues. You may meet new friends whose primary interest is your money. Strive for balance and be prepared to weather some tough times. Being rich may be the toughest character test you will ever face. Takeaways. 1. Start planning the sale of your business long before you sell. 2. Negotiate the best possible deal. 2. Don't get so focused on a deal happening that you get a bad deal. 3. Pick advisors based on the people you will work with, not the firm's reputation. 4. Take cash. 4. If you're paid in stock, sell it. 5. Take time to plan how you will reinvest the cash. 6. Consider such factors as taxes, estate planning, and insurance. 7. Draft a statement of your investment policy. 8. Assess your risk appetite and develop a risk management plan. 9. Remember that an investment manager's past performance is no guide to his or her future performance. 10. Manage your emotions. 10. Sudden wealth can be very trying. 11. Did you know that around 70% of our viewers haven't subscribed to our channel yet? If you're one of them, why not consider hitting that subscribe button? It's a great way to stay up to date with our latest videos and support our channel at the same time. 11. Join the majority of our community and subscribe today. Thanks for watching.